Let's go out to Chicago. Dr. J is joining us here. Dr. J, what are your sort of hypotheses as to what went on today?
Well, at the time it was happening, Melissa, it felt just like that the fund was being liquidated. And for the last couple days, that's what we've heard. And in the final 2 hours of trade, it's looked just like that. As you've, instead of a V, you've seen this kind of shape on the chart in terms of the VIX. They buy it up into the final hour of trade, and then they release it, and the volatility comes right back down. Now, today, that wasn't the story, but when they were just slamming it, and we didn't know that there was a fat finger mistake, whether or not that is, it certainly felt like fund liquidation. And what I would say about that is that I think we've come a little too far too fast. I don't think I'll get disagreement from anybody on the desk that there's great liquidity that all these firms pinging the market from around the world bring, but the fact that they're doing it in millisecond time frame and that these orders are entered that same way, when Mark Fisher comes on, I'm going to be listening because I think he'll say the same thing I am. Indy cars, you slow them down. NASCARs, you slow them down. They could put those cars at damn near 300 miles an hour around the track. Why don't they do it? Dangerous for the drivers, dangerous for the crowd. This, Wall Street, this is my Jim Cramer moment, by the way, Melissa, this has become dangerous for investors and for Wall Street. It's gone too fast. There are too few players who can afford to pay up for all the servers, the co-location, and all the rest, all the big computer hardware. Pete and I use 6 1-gigabit circuits to be able to see what's coming off the floors over at Trade Monster. So when we're looking at that, we're looking at 1 million quotes a second coming off the floors. Investors can never even look at that. So this is not a fair game. I mean, it's gone too far, too fast. Like I say, I think they can slow it down, and investors would have greater comfort if they did that, and I think it would be better for the markets, and you'd see less volatility. I'm not saying get rid of all the high-frequency traders.
Right,
I'm saying you need the same sort of governors that you have in NASCAR.
This does sound like a Jim Cramer moment, because it almost sounds like you're telling the average guy out there not to trade because you can't possibly compete with professionals like you and your brother.
And they can't. They can't possibly compete, but the average trader is not trading in millisecond time frame. Joe or Jane investor, they're buying a stock and they hope to buy Apple, for instance, at 246, and maybe they want to sell it at 250, 265, whatever it is.
Right.
That takes days, weeks, months to do that. These guys are buying in millisecond time frame, and because it's millisecond order entry as well, meaning, you know, 1,000th of a second faster than the human eye can see in several lifetimes, these orders are coming by too fast. This, if it was a fat finger or if it was a liquidation, came too fast. A normal person could have responded and said, this is too big. Are you sure you want to do this? And they would have pulled back.
I want to bring it back here to the desk, Dr. J.
Doc makes great points, but I'll say this, you know, if you're looking for hints as a retail investor, I mean, a lot of these stocks printed at very interesting levels. It's telling you that effectively, folks, that's where the support was. Take a look at Hewlett-Packard. What was the low today in Hewlett-Packard? I think 41 and change. So you know what? If you're building a list, if you're putting your laundry list together in terms of stocks, and you believe this sell-off is real, look at intraday lows of names like that. Now, Accenture, I understand. That's a little bit ridiculous.
Right.
But in an HPQ that traded down to 41.5, maybe the market gave you a little clue that that's where it's headed and that's where support
is. And I throw in an IBM in the same category. I mean, you look at that stock, it's down a couple of bucks today, but I mean, it didn't get pummeled by any, and the Hewlett, I'm just questioning that 41 print. Yeah. I mean, to Steve Grasso's point when he was talking about all these, you know, the charts are going to have to read this.
Yeah.
I just wonder, I mean, are the charts really going to read that penny? Because they're basing some of these numbers off of some of those S&P stocks that had ridiculously low prints. I mean, that's going to be something that I wonder. I mean, a Carter Worth or one of these guys who's really following the charts, are they really going to follow along with those low prints of the day? Because those don't make any sense at all.
And for the retail investors who do want to stay in the equity markets, this move of putting money into ETFs so they don't have to think about individual stock risk will continue. And so whether that's BlackRock or whether that's Vanguard, if you want to talk about it in terms of managing money, we've talked about it on this desk, the traditional asset managers that don't have the index funds, this is bad for them and it's good for those that have the index funds. BlackRock, beneficiary here, more people put more money in index funds. They don't have to worry about this volatility.
That's true, but if you're an average investor, we made this point at the top of the show, and you put money into an ETF at the beginning of the day or yesterday or 2 days ago, and you had a stop limit order in, and you got stopped out today because of a computer glitch, you're feeling pretty bad about the markets right about now, and you're probably a little bit less willing to put money back in.
Absolutely agree. But if you are an investor and you do want to be an investor, this will make you more likely to put something in a non-single stock product. Leave it at that, that they will be more content at least buying an ETF which won't have the crazy volatility that you would have had in an individual stock today.
Okay. We've got to take a break right here, but we have a very special guest coming up on the other side of this break. Mark Fisher of MBF will join us, and he will tell us why this is what happens when computers drive the trading. Stay tuned. More Fast Money is up next.